You're listening to the Real Estate Runway podcast, powered by QUATTRO Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
All right, Real Estate Runway family. Today, we're going to have Brian Head, founder and CEO of Head Start Equity. This individual is a fellow Black Card Fund Launch member and a fellow Texan as well, and a veteran real estate investor. So we're going to learn a ton about his experience today and honestly, why you might consider as an investor investing in a fund which spreads risk across multiple syndications and operators versus the traditional syndication model. So we'll talk a little bit about that and how it might benefit you and what some of the drawbacks might be. So without further ado, let's get right into this episode. And wait, if you stay tuned till the end, you're going to hear about the fund he actually has in place. And you never know, they may be one of the partners of QUATTRO Capital on future deals. So before we get into the episode, if you have any value obtained out of the show today, please leave us that 5-star review and thoughtful comment. That's how we get to more people like you. Pay it forward, leave the comment, hit the stars. If you're on YouTube, like us and subscribe. That'd be fantastic. Leave us a comment. That's the only way to get to more people just like you. If you want to visit us on social media, we are all at Team QUATTRO Capital, one word, no special characters on all the socials. And if you're watching on YouTube, you can also check us out at Real Estate Runway Podcast on TikTok for your swiping pleasure. Now, if you want to be on the show, please email us at podcast@thequattroway.com or just visit us at thequattroway.com/podcasts. And now on to your scheduled production. All right. Real Estate Runway family, welcome to an episode of the Real Estate Runway podcast. I'm your host, Chad Sutton. We are powered by QUATTRO Capital here in the episode. And I want to introduce today a good friend of mine from the Fund Launch Live Black Card Network, which we have recently joined. Great, just thought leadership, people coming together, everyone in the real estate, hedge fund, all the financial spaces in one mastermind group. It's just fantastic. Brian Head, CEO and founder of Head Start Equity. Welcome to the show. How you doing today, brother? Good to see you.
Good, Chad. Thanks for having me on. I really appreciate it, man.
So before we get into it, you and I were just going through your background and it's quite impressive. But before we start talking about our episode today, tell me a little bit about yourself, your history in real estate, which is extensive, and what kind of got you moving towards the fund model that we're going to talk about today.
Absolutely. Yeah. Thanks again. So I'm in San Antonio, Texas, born and raised here. I lived here all my life.
Hold on. If you're on YouTube, does this anger you or make you happy? Let's see.
That makes me happy.
Okay. And for those who are listening, I was holding up the Hook'em Horns, Texas Longhorn, all that kind of stuff. And you never know. He smiled, but I didn't know if I was going to get thrown through the screen or not if he was an Aggie. So back to you. Good to see you.
We're good. Yeah. So married, have 2 kids, both daughters, 5-year-old and 12-year-old. They obviously keep me pretty busy. And so I've been investing in real estate for about 20 years, a little over 20 years now. I recently, as of May of last year, I left my job, my W-2. I worked for a large financial services company based here in San Antonio. I was there just shy of 25 years. About half my time there, I was a stockbroker. I had my licenses. And so I learned a ton in that space. So just been doing a lot of different things. But like I said, financial services industry, I did that for quite a while, learned a lot. And I honestly got my investing bug back in high school. I had my economics professor back then had us, I'm going to date myself a little bit here, but had us tracking stocks in the newspaper. And that was my first foray into investing. And so that I piqued my interest. And so as soon as I graduated, I started, again, dating myself, going to the library, checking out books to learn all I could about investing. There was not an internet back then. So that wasn't you couldn't look at all the stuff you could so easily as you can today. There weren't podcasts, wasn't anything like that. So it was all books and going to the library. And so learned a lot about investing. Like I said, started out at a large financial services firm here in San Antonio. Got to work with a lot of awesome investors over the years. Got to work on what's called our active trader line. So putting in trades for people that wanted to trade options. And I had some interesting times there. It was one of those things where it was moving so fast. You'd talk to people, would call up and just start rambling out their order they wanted to put in, forget the pleasantries and everything. And if you couldn't repeat it to them after they said it one time, they're like, transfer me to somebody else type thing. So it was a lot of fun. I learned a lot, but so did that for a while, but I was investing in real estate during that time as well. My real estate path is very similar to a lot of people's. Started out in single family. So when I moved out of my parents' house, I bought a HUD foreclosure. It's just a little 3-bedroom, 2-bath, 1,231 square feet house, but actually house hacked from day one. So I rented out one of the rooms to a coworker. And so that way I was bringing in a little bit of income and fixed it up a little bit. And that was my first real estate investment. And I kind of got the bug for real estate at that point, and then started dating my now wife. And funny enough, we started buying rental properties together before we were ever even married. So we bought several rental properties and started renting out single family houses, and then started doing some flipping. So I've flipped about a dozen homes as well. And then I got into smaller multifamily, duplex, triplex. I've even done an Airbnb, which I still got, but should be selling that here pretty soon. So I've done a lot of different things in the real estate space, but a few years ago is when I got into the larger projects, multifamily, value add, large 100 plus unit complexes, things like that. So that's my journey at a high level.
And I was cracking up at myself a little bit because I was going to crack a joke about you dating yourself, what with having a shiny head as well. But I have gray in my beard. And I actually remember when Ask Jeeves became a thing and you couldn't use it in your English papers and stuff like that. So anyway, I also have just dated myself in trying to date you. So I'm a little depressed after that, but it's okay. So Brian, I'm going to throw you a curveball real quick. And full disclosure, folks, if you hear me call him David, it is not because I don't know his name. It is because one of my best friends from college was named David Head. And so if that happens, just overlook it. Give me some grace. I need some space for grace in my life, but we're going to work to call him Brian and the whole thing here. So I'm going to throw you a little bit of a curveball though. So you've been investing in real estate for 20 years. And anytime I hear that, I'm like, okay, this guy's probably got some scars and stripes somewhere, right? And so you, depending when, if that's 20 plus or minus 5 years, you either started somewhere after the dot-com burst or you at least went through the Great Recession. So any real estate lessons that, don't be shy. We've heard all of them here, but everyone had a different experience of why they either got crushed or made it through 2008. But I'd love to hear just, what maybe I'll never do that again comes out of you from 2008.
Yeah. So my never do that again is probably from a few years after 2008. But honestly, I had a few properties before 2008. And after that happened, they went down in value. I will say that I think Texas, unlike some of the other markets like in Arizona or Florida, they didn't go up as much. So they didn't quite get hit as hard when things went south. And Texas is a pretty robust state, a lot of migration here for a long time. So it wasn't the same as some of the other markets. What I did do though was take advantage. We all say this, right? We wish we would have taken advantage of it more. And I even knew at the time when 2008, 2009 was going on, I was like, man, I wish I could get more properties because they had a program at the time for VA properties that were foreclosed on called VA Vindy loans. And I don't know if you ever heard of that, but those were pretty awesome loans that were giving similar terms to VA veterans that could get those loans. And so to investors. So I could get not much money down, part of your closing costs paid for, great rates like 4.5%, which was amazing back then. And that was a fixed 30-year. And they were just trying to get rid of this flood of properties they had. And so I definitely took advantage of those. Most of my rental properties that I picked up were through that program. And so, but I always said, God, this is like a once in a lifetime opportunity. I wish I had more money. And now in retrospect, I wish I knew then what I know now about raising capital, using other people's money more and stuff like that, because wow, I'd be sitting in a much different place right now had I done that. But yeah, so that was some of the things in terms of a scar. So one of the mistakes I made, especially in the flipping space, my only deal that I flipped that I lost money in was when I decided to go get in a larger, more expensive property to flip. And it was basically buying something that a majority of the folks in town couldn't afford, going outside that sweet spot and medium range.
Smaller buyer pool kind of thing. Yeah,
much smaller buyer pool. And so that ended up not working out well. I did have some investors in that deal, but I made them whole. They got all their interest I promised them and everything. I'm the one that took the hit because it should be me because I was the one responsible for it. So that was definitely a valuable lesson that I learned. Honestly, I only did one other flip after that, and that was a really small property. But so that was one of my biggest lessons in real estate.
Walking backwards on a couple of things there. And folks, this is why Brian is on this show and not somebody else, because I don't know how we do it. We somehow pick the right morally and ethically aligned people, because that situation could have gone one of two ways, right? The sponsor could have said, well, sorry, you guys lost money, but I'm not putting my money in, or something like that. And I still made a little money. But Brian made sure that his investors were made whole, because the one thing you have in this business is your reputation and your relationships. You blow either one of those things, you're dead when you're working with other people's money. So I can't believe you glossed over that, because I'm going to make a big deal out of that, because that's a big deal just from an investor perspective. I appreciate that. Going back a little further, you mentioned that you didn't get a lot of those scars and stripes because you were invested in good markets. And I cannot stress that enough. If you go back and look at news from the years 2008 to 2011 and type in 2008 to 2011 real estate news, you're going to see horror story after example, after horror story, after embezzlement, after someone made a bad decision here, like all that kind of stuff. But if you notice, and if you go research the markets back then, real estate is a local sport. It is not a national sport. We average it all and we look at it nationally, which doesn't mean a damn thing. But we look at it nationally and that's okay. Well, yeah, the real estate market tanked. Well, to your point, strong markets like Texas, strong markets like Tennessee, strong markets like North Carolina. If you look at the demographics and the in-migration and the population growth and that's the same thing, wage growth, job growth, all that kind of stuff. If all of that is historically robust, it's not likely to take the hit. Whereas your Reno, Nevadas, your Phoenix, Arizonas, your areas where they're just more prone. I mean, shoot, there were areas in Texas like Midland, Odessa, for example, oil town that blew up. So that's a bad analogy. It didn't blow up, but it actually tanked, right? So thinking of it that way, you're actually pretty safe even in recessionary times if you're in strong markets. So focus on the market, not the national news. And there was one more thing you said that I wanted to bring back to. You were saying, man, I wish I would have known what I know now about using other people's money as well as my money to buy these things, because I would be in a very different situation. Well, both sides of the coin, you and whoever else invested with you would have made a ton of money. Like even maybe you only owned 20% of what you bought, but you would have bought 10x more or something like that. You and your investors would have made a killer amount of money. So I got to spread the word. If y'all aren't using other equity to grow, you should be, because there's always, for every person with a deal, there's 10 people with money trying to grow it. And by the day, traditional investments are losing interest, trust, and popularity because Wall Street just hasn't been kind to the individual. So anyway, that's why we're on this show, Off Soapbox. Brian, I love getting on those. So thanks for bearing with me there.
There you go.
Let's transition a little bit into the fund of funds model that we're going to talk about today. And why would an investor invest in, like at QUATTRO Capital, we do projects.
Right?
We
So a lot of our
do a
focus is
syndication where we buy a project and we offer investors to come invest with us. And maybe we accept anywhere between 100,000 and $1 million from every investor, and they're in that one project. You know, what you are doing is more of the fund of funds model or the investment fund model. So let's talk about the fund you created, why you created it, and what that strategy might offer to investors instead of going straight into a single asset fund. Let's go there.
Sure. Yeah, happy to. So we were talking a little bit before the show started, but so I've been a co-GP on eight deals, all here in Texas, all value add multifamily. And it's been just such a great value in terms of the knowledge that I've gained and everything. And my venture into multifamily in the larger space, I started listening to podcasts. I joined a local mastermind group. Those were some of the things that I did to shortcut my path a little bit. But I had some personal family things that happened that actually were the impetus for getting into the larger multifamily space. And I'll just touch on that real quick if you don't mind. But
yeah, please.
Yeah. So right before I started, so back in 2018, my wife was diagnosed with breast cancer, and she's cancer-free now, though, thankfully. And we're past that, moving forward. But the reason I bring that up is because that was the life event that really caused us to step back and reflect on life and what we're doing and why we're doing things and how important family is and all those things that I think most people, including myself, prior to going through that, take for granted, right? You just, so yeah, life's short, blah, blah, blah. Well, when something like that happens, it's okay, no shit. Life really is
It's short.
Can be very short. My wife, when she was diagnosed, she was 38. So no family history, A grade, worked out, took care of herself. There was no reason for it to, you would think, to happen to her. But anyway, I started, when that came about, my why basically became, I want to get my wife out of her corporate job so she can spend more time with the family. And so that has been my mission. And that's why I got into multifamily, because I realized that single family was going to be really hard to scale. I'm not saying you can't do it. Now, some people scale it and do really well. It just wasn't the direction I wanted to go. And so when I jumped into multifamily, I started investing passively in 3 deals in about a month. I was like all in. I want to learn. As it was going on, we were into COVID. And somebody that I had a ton of respect for, that I had invested in passively, I was like, I want to go meet this guy. I want to go meet him in person. So I flew up to Chicago, met him in person, stayed for one night just to have dinner with him and learn more about what he does. And so when I say I was all in, I was all in. I wasn't messing around. Failure wasn't an option. So that's what got me started. And so fast forward a little bit, some of those deals I've been in, they've gone good. We've had some bumps and stuff like that. And then I reflect.
And everyone does, right?
Yeah, exactly. Yeah. And I reflect back to my time as a financial advisor and stockbroker. And during times like this, I feel like it's super important to, one, diversify and also invest in good quality assets. And so that was the purpose for my fund and what I'm really trying to focus on with my fund. So to talk a little bit about the fund. So it's going to be smaller on the raise side. I'm only looking at $5 million on the fund to raise, 5 to 10 properties in the fund, and all Texas multifamily. So I'm sticking to the state that I know well. I've been here all my life, just have a tremendous amount of confidence in the state. Obviously things can happen, but one of the crazy stats that you may have heard about Texas, if Texas were a country, it'd be the 9th largest from a GDP standpoint, right? Bigger than Russia.
Isn't that wild?
Yeah, bigger than Canada, bigger than Spain. I mean, it's kind of crazy when you think about it. 2.4 trillion last year. It's crazy. So that's why I decided to focus on Texas. I'm a big believer in value add multifamily. And I also am a big believer that there are going to be more and more opportunities right now. So there's a lot of people that are afraid to invest right now. But I also really strongly believe you got to find the right person to invest with. But if you feel confident in them and their thesis and what they're doing, you got to do it, because when everybody else is afraid, that's one of the key indicators of it's probably a good time to invest. You don't want to buy high and sell low. That's not the name of the game, right? So that's what I'm focusing on. I will say, just to add a little bit on my fund, it's structured a little bit differently than some of the other funds out there. So I'm not an operator on any of the deals I'm investing in. So I'm basically running my fund. You could look at it like a hedge fund, right? So I'm investing in other operators' deals. And one of the main reasons I did that, it was very purposeful, because I don't want to be limited on the deals that I can invest in this fund by deals I have to be a co-GP on, where somebody needs me to come in and help them raise capital. I didn't want to be limited like that. I want to be able to invest in the best operators and the best deals, regardless of whether I'm going to be on the GP side, general partner side. So that was very intentional. And I only want to invest, and I'm only going to invest with operators that have a track record, that have gone full cycle on multiple deals, that have conservative underwriting, all these. The good thing about it is, with having been a co-GP on multiple deals, the due diligence piece is one of the biggest things that I'm able to bring into this fund, right? And that's one of the value add propositions for the fund. And so, and the interesting thing is that I've already got 2 deals in the fund. One's a 360 unit complex in Dallas. Another one's a 114 unit in San Antonio. And both of those deals are actually with operators I personally invested with passively myself. They haven't had to pause any of their distributions, even with all the rates going up. They haven't done any capital calls. So these are some of the things that I'm really looking at. But this is probably going to blow you away a little bit, Chad, but the fee structure, right? So I've capped my administration fee at 1%. So for those that don't know, having a fund, there are expenses, right? There's going to be accounting expenses, compliance expenses, and things like that. So I've capped it at 1%. If it goes over 1% of assets under management, I'm covering it myself. If it goes below 1%, that's all I'm charging those. So if it's 0.5% of assets under management, the actual expenses for my fund, that's all I'll charge. There is no promote. There is no equity split. There's no management fee. There's no placement fee. Zero. There's nothing else.
That's very interesting. That is super unique. And so I assume you're not working for free. I would assume that you're eating out of the sponsor's share or the equity.
Nope. The only money I'm making in it is the money I've invested in my fund alongside.
There you go. Okay. You're co-investing.
So I put in some money I co-invested, and that's it. Just a couple reasons why. So one is this is my first fund. So I'm trying to set it up to be very favorable for the investors. I also feel like there's a lot of funds out there that are actually, I don't want to call them out. I'm not going to say who they are, but there's funds out there that are a little exorbitant when it comes to fees. I'll just put it that way. And so I'm really trying to buck the trend on that. And this is my first fund. The goal is to have then a $25 million fund next year. And then shortly thereafter, a $100 million fund. And on the $25 million fund, I will be adding a management fee, and that will allow my wife to leave her job. So that's the goal. And so I'm not looking at it short-sighted. I'm looking at it longer term.
Very good. That is unique. So I've actually never heard of the as is or capped management fee. It's a good concept, and it definitely incentivizes you to keep expenses low, right? In the fund.
Right.
So yeah, lots to unpack there. So let's kind of talk. And by the way, I love what you said about Texas. We are also operators in Texas, and it's incredible the magnitude of economy that is in that state. So while we may be talking about downturns nationally, it's well, sure, but are they really going to hit the primary markets or the secondary markets in Texas? I don't know. TBD, right? Likely not. And they didn't before either. So that's fantastic. And also love that you're investing in operators you have personal experience with and who are currently doing well. And when you have courage and capital, at times others don't, is when you make money. And so this is the right time. So let's say an investor has $200,000 available in their endowment to invest, right? And let's say that most sponsorship groups like QUATTRO, it's going to be $100,000 minimum. And so with us, you would deduce by our incredible powers of analytics that with 200,000, you can invest in 2 syndications with QUATTRO, probably. And as we mentioned, 2 properties. With your fund, let's talk a little bit about how the diversification factor would apply with your fund versus basically having to put 100,000 in each investment individually.
Yeah, absolutely. So the minimum on my fund is $50,000. And so you put in $50,000, you are passively invested in all of the deals that were purchased before you invested and all the deals that are purchased after you invest. So it is a true diversified fund. So you are diversified across all of the assets in the fund. One of the cool things is because of the way I've structured my fund, yes, you're diversified. This is the traditional definition of diversified. If you're investing in one type of asset, is you're diversified geographically, right? So, and that's true. So I'm going to be focusing on the major metropolitan areas and the MSAs in those areas, San Antonio, Dallas, Houston, Austin, things like that. The other cool thing is you're also diversified from a sponsorship team standpoint as well. So one of the things that I've learned is that different sponsorship teams have different ways of underwriting deals. Some can be a little bit more conservative than others, right? We all use the basic same spreadsheets and stuff like that. But I think it's important to be diversified from a sponsorship team as well. And you're going to get that in my fund because I'm investing with different lead sponsorship teams and in their deals. And again, I'm only doing it with operators that have a track record and that are able to show me what kind of profits they've made and so forth. And so, yeah, it really is truly diversification. And I'm not aware of any other funds like this where they're this low on fees and you're able to get this kind of diversification with this small amount of money, really.
Yeah. And this is the beautiful thing about it. So why would QUATTRO bring this fund on the show? Well, this is everyone grows in this situation. So whether it's a QUATTRO Capital or a passiveinvesting.com or a Ashcroft Capital, whoever we're talking about, all big quality operators. And now with a nominal investment, I mean, it wasn't that long ago. I didn't have 2 pennies to rub together, y'all. So I get it. 50 and 100 and 200 grants, a lot of money, right? And so you want to make that money grow as safely as possible. So if you get to go get these type of returns and diversify it across 3 or 4 different operators, we're all still winning. The operator's still getting the investment, and the fund manager is getting to co-invest a large level of endowment with these sponsors, and the individual gets to get diversification. So it's a pretty incredible way for everyone to win by playing together. That's how this works. That's why syndication is so great. And so, Brian, I think I have 2 more questions, and then I'm running the risk of breaking my own rule and going over 45 minutes, but this is such a good conversation. 2 more questions here. One, so detailed question. When you go into, let's say, an Ashcroft Capital or a Quattro Capital, or like whenever you invest in one of these groups, do you mirror the return structure that operator is offering, or do you have a standard that the fund distributes? Like, how do you marry those up? Does that make sense?
Yeah. So basically my fund, the target return for my fund is 16 to 20% annualized return. The interesting thing is this fund doesn't have preferred return because there's no split. So there's no reason to have, so everything goes to
It's the return.
investor.
Yeah.
And it's the one up to 1% admin fee, right? But yeah, so I'm looking for investments that fall within that 16 to 20% annualized target. So that's what I'm focusing on. Hopefully that answers your question.
It does. And so said a different way, is an investor going to receive well, I have to say this properly because technically you will, because you're getting the benefit of investing in multiple deals, but is the investor going to experience a different return than if they just invested directly in one of the operators, if that makes sense?
Yeah, that's a very good question. And here's an interesting point about that. So one of the cool things about the fund as well is my goal is to, with the deals that I get into, and for those that have a little more savvy about these different syndication deals, the larger checks that investors, whether passively or actively, whatever, bring into a deal, you might be able to negotiate some better terms. You might be able to get a different class of shares. And let's say the typical syndication split is 70-30 on a deal. Well, if I come in with $500,000 into a deal, it's possible that maybe I can negotiate with the lead sponsor and say, hey, I'm bringing in $500,000 into this deal. Can you give me an 80-20 split, maybe an extra % on the pref? And these are realistic expectations because I have talked and negotiated some similar terms. So you could technically, and this is no guarantee, but you could technically get a better return than being invested directly in the deal with your $50,000 and be diversified. So it can really be a win-win from that standpoint.
Yeah. And I'm really glad you went there. That's where I was hoping you'd go. And the reason that is, folks, is just speaking from the operator perspective. If Brian can come to me and say, hey, I will invest $2 million of your $10 million raise. Well, shoot, that's 20% right there. Okay. And that's less tax documents I have to do. That's less distributions I have to do. Like it really starts to lower the expense ratio and effort required to do what we're doing. And so there is some value in investing in not only getting diversification via the fund, but also you very well may get better terms because you're coming in as part of a larger check writer. So that's how the world works. Everyone gets scaled that way. Fantastic.
Yeah, it's like kind of capped my admin fee of 1%. That kind of helps with the possibility of getting a pretty good return. Now, had I had management fees and some of the other fees, well, now you're starting to dilute the returns a little bit and it may be a little closer.
Yeah, it's fantastic.
Oh, yeah.
So let's take this into the Quattro questions real quick before we let you get out of here, Brian. I love what you've set up and it's really a win-win for everybody. So first question, what is your superpower in life or business and how does it benefit you?
If I had to say I have a superpower, I would say it's being able to connect with people, honestly. And I think a lot of that has to do with the fact with how I approach people, honestly. And I don't say this to just try to sound sincere or whatever, but honestly, when I meet people, when I talk to potential investors, I approach it with, hey, this could be a great opportunity to make a new friend. So in all honesty, I have a business coach and he's told me, Brian, you're a great educator. You're just not the best salesperson. So I really just love to educate and help people. And that's one of the other reasons why I started the fund, because it allows me to focus on helping educate and really build those relationships at a deeper level than having to operate a property. Right. So I'm able to focus where I really enjoy and doing what I really enjoy. And that old cliche, it doesn't feel like a job. It really doesn't, because I enjoy educating people, love building relationships. I'll make introductions with my investors to other. I had an investor one time say, hey, I'm doing a quarterly check-in with him and said, hey, how you doing? And he's, thinking about buying a laundromat. I'm like, well, I don't know much about a laundromat, but I could connect you with a business broker I know. And so the three of us had lunch and he got to learn more. I got to learn more. So anyway, just connecting with people on a real genuine level, I would say.
Yeah, it's super powerful because, I mean, if you have that giving heart of giving your time and your relationships and all that, you never know what you're going to learn and who you're going to help along the way. And then, man, there's that human gene of reciprocity, right? Where we scratch your back, now you're going to scratch mine one day. So it's pretty cool. All right, let's flip the coin for a second, Brian. What's your biggest failure, life or business, and what did you learn from it?
I think one of the biggest ones was that flip that I mentioned earlier. So, and I'm not ashamed to say I lost 40 grand on the flip. That's not a small chunk of change, especially back when that could have easily stopped a lot of people. Would have been like, okay, I'm done. No more real estate for me. I'm good. I just lost 40 grand. Took a long time to make that money. I'm good. But I just muscled through it. And over the years, even before that, I made well more than 40 grand. So you can't win all the time. That's just, I don't care who you are. Warren Buffett's lost tons of money. Ray Dalio's lost tons of money. It doesn't matter who it is. They've all lost. Grant Cardone, I don't care. Everybody that has invested. If you're not losing money, you're not investing. So that would probably be one of the biggest ones, but just muscle through it, like I said.
Another plug for the diversified fund is they don't all go well. Sometimes you're going to have one, and if you're in a fund, you're going to that's going to be blended out. So
Exactly. Yep.
I love that. Well, let's jump over to the philanthropy question for a minute. So here at Quattro, we're based on 4 pillars: people, property, profits, and then philanthropy, coming right back around taking care of people. So I love to give our listeners, or our guests rather, an opportunity to share with our listeners their philanthropic heart. And we've had a ton of reports of people actually like giving to those charities where the hearts matched. So what is your philanthropic heart? And let's talk about that for a second.
Yeah. So for us, it really goes back to the life event that we had and with what happened with my wife and going through the breast cancer. And it was a really dark time. I mean, when she was diagnosed, our youngest daughter was 4 months old. She was breastfeeding, and that's how she found the lump. She thought it was a clogged duct. And once that went away and she still had a lump, it was like, well, I better get this checked out. So she did. And so we have a partnership with the Breast Cancer Research Foundation out of New York. It's on our website. So we're trying to raise $10,000, whatever gap we can't raise, we're going to be contributing ourselves to that foundation. We're also exploring the option of creating our own not-for-profit foundation as well. But that's really obviously for obvious reasons near and dear to our heart. And one thing I will say too, like I said earlier, my wife was 38 years old when she was diagnosed. So don't think that just because you're young, it won't happen to you. She was not doing regular checkups on herself. And had she not been breastfeeding, she probably would have never found it. And who knows where we would be today, because one of the interesting things that I learned through this process is when you're younger and you get breast cancer, it tends to be more aggressive, an aggressive form. And so she had an aggressive form. And so it grew quickly. And so had she not found it like she did, who knows where we would be today. So I would just say that if there's anybody listening, make sure you're checking yourself. If you obviously have a family member or whatever, let them know, regardless of age, they should be checking themselves. So that would be that's obviously one of the most important things to us. And that's a message that we want to try to share.
I love that, Brian. And most of you who are well acquainted with the Quattro team will probably know by following our social media that one of our managing partners had a cancer scare where there was some cancer found, unfortunately, because she just gave away 3/5 of the team because she was regularly getting checked, right? She was able to catch it before the word isn't metastasized, but hit the lymph nodes and spread.
It is
metastasized.
Yeah.
I didn't know if it was that way for skin cancer as well, but okay. So that's the word. And that's a great plug. And folks, if that is near and dear to your heart as well, scroll down into the show notes. That link will be right there for your clicking pleasure in whatever modality you're listening or watching on. I hope even TikTok. Yeah, we're on TikTok now, Brian. You believe that? That's weird.
Wow.
So for your swiping pleasure, I guess is that TikTok or I don't know. I'm not hip on social media anymore.
I'm on LinkedIn and that's it. So I don't know.
Yeah. I recently closed down my Facebook because it got too advertising. But anyway, well, yeah. So thank you for sharing that. Thank you for sharing your heart, and very, very happy to hear that your wife is blessed and has been able to overcome that. And now you're sharing the message rather than, so that's fantastic. And last question, we've been holding it till the end. How do we get in touch with you, learn more about the fund? Tell us about the fund itself and where we can find it and you.
Yeah. So the best way to reach out to me is just, you can send me an email at brian@headstartequity.com. My website is headstartequity.com. You can reach me that way as well. The only social media, like I said, that I'm on is LinkedIn. So you can feel free to hit me up on LinkedIn as well. But yeah, and I'm, like I said earlier, I'm really big into educating, and I've had people reach out to me that are starting out in single family or trying to transition from single family to multifamily and maybe want to do something active. And I'm willing to help in any way that I can with that journey. And so, yeah, just definitely reach out. And obviously happy to talk about the fund in more depth. I think it's a great opportunity. Like I said, I don't think you're going to find anything else out there like it. So if it's something you're looking to do, if you're looking to get into value add multifamily, reach out to me for sure, because that's a great offering. But I'm willing to help in any way that I can.
Thank you for that, Brian. And folks, he's good peeps. Not only is he a Longhorn, he's a Texan, specifically a San Antonio, or I don't know how you say that, but Aaron Hudson, who's one of our partners, lives probably very close to him, actually out in Bernie in San Antonio. So we'll talk about that after the call. Yeah, exactly. So he's good peeps, came out of the Fund Launch Black Card Network, so we know he's legit. So give him a call, see if he can help you. And if nothing else, say hello, because that's the thing to do these days. So, all right. Brian, thank you so much for coming on the show, spitting some knowledge, sharing with everyone. And I hope to have you back on the call someday when you have your $25 million fund launch.
Awesome. Yeah. Thank you. Thank you for having me on, Chad. It was an honor. I really appreciate it.
All right, folks. I hope you got a lot of value out of that show. There's a little irreverent humor that went on there, but you got to love joking with a fellow Texan. So if you are interested in the fund model, please scroll down and check out Brian's website. It will be right here for your clicking pleasure. We're always willing to work with you here at Quattro Capital. So check us out at thequattroway.com/invest. Either way you do it, Brian can help you. We can help you. We're always here to help. If you got any value out of this show, please leave us that 5-star review and thoughtful comment on the podcast platform. Or if you're on YouTube, like us and subscribe. That is the only way to pay it forward and get to more people just like you. That's how you found the show, and that's how the next guy will find the show. So thanks for being awesome. I'll see you on the next episode of the Real Estate Runway podcast. Until next time, over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway podcast.